RBA Governor Philip Lowe faces Parliament. Let's have a look. Hello everyone, welcome to another episode of Heise Says. Still working on my morning shine, and when I thought we'd look at this article from news.com about Philip Lowe appearing before a parliamentary committee, because frankly, I'm quite interested in how our politicians are responding to his changes in monetary policy. So let's have a look. RBA Governor Philip Lowe appears before Parliamentary Committee in Canberra. The Reserve Bank of Australia Governor Philip Lowe has issued a thinly veiled message to the government, please do more. Well, he's issued that several times, again and again and again. I don't think it's going to surprise anyone who's been following any of his statements or what he's been saying, because there's only so much he can do. There's only so much he can do. More and more of my exposure to the Austrian school, I really question the ability of our Reserve Bank system to, steer the economy based on outdated data. But that's just my cynical approach. So Dr. Lowe told the government's Economics Committee in Canberra this morning the Australian economy was at a turning point, as he outlined the RBA's latest forecast. Those forecasts included a prediction that economic growth will be lower than previously expected. The RBA now predicts GDP growth of 2.5% this year, rising to 2.75% next year. Inflation will remain below the RBA's target for some time. Unemployment will stay above 5%, and upward pressures on wage growth will continue to be quite modest. Does it even exist? Is there any pressure on wage growth when your unemployment rate is that high? Let me know what you think in the comments. If you've experienced wage growth in your job, or if you've increased the wages of your staff. I think, that's the thing. There's wage growth for staff when you want to reward them, when you want to keep them, or when they progress in their career. And then there's due to market forces, when you need to pretty much lift the wage to ensure that you're meeting the market. So let me know if any of your growth has been the result in your wages of your staff due to the market, as opposed to rewarding people, because I would wonder. Dr. Lowe blamed the revisions on weak consumption growth at the domestic level and major uncertainty internationally as a result of the trade war between China and the United States. It has become increasingly clear that the extended period of unusually slow growth in household income has been weighing on household spending, he said. He said caps on wage growth in the public sector were contributing to the problem, and a pickup in wages would be both affordable and desirable. Well, from whose perspective? If you're in a business environment where you need to reduce your costs, and wages are a significant portion of your costs, and there is no market demand for you to drive up your wages, I mean, come on, isn't this just simple economics? See, that's the thing. I'm thinking of it from a small business owner's perspective. That's where my view is guided by, and probably biased by, my own lived experience. Now, as the Governor of the Reserve Bank of Australia, has the good doctor ever run a small business, ever faced those challenges? I'm wondering. There's only so much the RBA itself can do. With the cash rate at a record low of 1%, there is very little room to move. I'd say there's no room to move. Very little. With that in mind, Dr. Lowe pushed the government to consider two possible methods to stimulate the economy. Either more infrastructure spending or structural policy changes. Now, this is the thing. I want to have a look at the different types of infrastructure spending and what the benefits are going to be. I mean, case in point, NBN. Just the whole debacle of that infrastructure spending. How can there had to have been a better way to do it than to hamstring the telcos who are already rolling out fibre. Had to have been. One option is for fiscal support, including through spending on infrastructure, Dr. Lowe said. Spending on infrastructure not only adds to demand in the economy, but done properly, can boost the economy's productivity. It can also directly improve the quality of people's lives through reduced congestion and improving services. that's the thing. They're playing catch up. So our economy, well, our real estate sector overheated due to this is some theory crafting here. We saw the increase in previous episodes, just the amount of foreign investment into our real estate sector, particularly in Sydney and Melbourne, as a proportion of all of the approvals. It was insane. Our population grew by 25% from 2000 in the last 20 years. That's big growth. Big growth. So perhaps our infrastructure hasn't kept pace with all of this. And I mean, is it just me, or shouldn't some of our stamp duty and fees that we're paying to the government, headworks charges and those type of things when you buy and do development, shouldn't that go towards infrastructure? I thought that was what a portion of it was. No, well, what do you reckon? Let me know what you think in the comments where it's all gone. At the moment, there are some capacity constraints in parts of the infrastructure sector, but these should not prevent us from looking for further opportunities to boost the economy's productive capacity and support domestic demand. There is no shortage of finances to do this, with interest rates the lowest they have ever been. This week, all governments in Australia can borrow for 10 years at less than 2%. Hint, hint. That's, fantastic. Fantastic. That's what we want to encourage. Borrowing. Why don't they borrow for 10 years at that percentage and pay off longer debts? Yep. The other structural approach would involve policy changes to support firms expanding, innovating, and employing more people. Yes, I agree. Make it easier to fire people. Remove the incentives which have appeared for businesses to contract their employers out to third parties so they don't have the hassle. Talk to anyone who is working through a contracting business, just the terrible conditions they have. Okay, that's the problem. When you put all these burdens on business people, you're going to discourage employment. And what do the big companies do? They contract it out so they don't have to deal with any of the crap. They'll happily pay a premium. They'll pay money to a third party that doesn't go to the actual employee to take away that risk from them. And, who gets worse and shafted in the end? The worker. So the people who are pushing for all these things, we need to be fair for the worker, this. In the end, you're probably screwing it up for them. I know it sounds counterintuitive to say making it easy to fire people to encourage more employment, but that's complex understanding based on lived experience and meeting people that have worked for some of these shitty companies. Oh, don't worry, everyone will just do gig economy jobs. There's a lot of security in that, isn't there? What happens if you make your living off Uber and you get sick? Someone, let me know in the comments. The Uber drivers, let me know. So the news wasn't all negative. Dr. Lowe cited lower interest rates, the recent tax cuts, the depreciation of the dollar, a brighter outlook for resources investment, higher infrastructure investment, and a correction in the housing market as positive factors to the economy. Okay, brighter outlook for resources investment. We'll bring up my favorite website, and I'll just remind you here that iron ore is 20% of our export economy, and then what we'll do is we'll bring up the latest iron ore prices. What do you think it is, guys? It's last time I checked, it was down to $90, and I'll just bring this over now. Where are we going? Iron ore, copper, lead, aluminium, zinc, iron ore, $95. It's going back up. But that seems like a rather sharp dive there, and we're looking at the historic chart now. So in some ways, perhaps it's only just because it's a recent news. Considering a fifth of our export market has taken a big hit in iron ore and international demands. Perhaps also the continuing trade dispute between China and America. Does that paint a bright outlook for resource investment? Maybe gold and silver mining in Australia. Maybe that's one to look at. Leave me any of your stock hints in the comments, guys, for gold and silver miners, because I'm actually looking into some and would be interested to know. There are signs the economy may have reached a gentle turning point, he said. We are expecting quarterly GDP growth outcomes to strengthen gradually after a number of disappointing numbers. We haven't even hit a recession yet. How are we going to get the return? Officially, it hasn't been declared. It is reasonable to expect that together these factors will see growth in the Australian economy return to around its trend rate next year. So let's remember this. We'll remember this for next year, and we'll see if his prediction is correct. And what happens if it isn't correct? Will it be dredged up and commented on? What do you think? But the situation has undeniably deteriorated since his last appearance before the committee earlier this year. At that point, he told it the chances, it being the committee, of the cash rate going up or down were roughly even. Since then, of course, the RBA has lowered the rate twice to a record low of 1%. Well, that just tells me his ability to predict. Right there. You've got to remember, guys, these people are trying to predict future results based on outdated data by the time they get it. And then they're just questionable. There's different ways of interpreting the data. Just the differences between the ABS and the Roy Morgan approaches to unemployment itself causes a huge difference in those figures. And one, I would argue, is probably more realistic, and the other is more academic. So a reasonable question to ask is what changed? And the answer is the accumulation of evidence that the economy, see past data, that the economy could be on a better path than the one we were on, Dr. Lowe said this morning. He justified the decision to lower the cash rate, saying it would boost jobs and help make more assured progress towards the inflation target. And remember, the more inflation they get, they want to encourage and nudge people to spend their money by decreasing its value. They want inflation. I acknowledge that lower interest rates do hurt the finances of many Australians who rely on interest payments, he conceded. But lower interest rates do put more money in the hands of the household sector in aggregate, and at some point this money will be spent. Will it? I'd be interested to see if it addresses mortgage stress, if it accounts for people who are in arrears. Concerning international developments, can see the economy underperform our central scenario. While we might wish it were otherwise, it is difficult to escape the fact that if global interest rates are low, they're going to be low here in Australia too. Dr. Lowe also defended the board's decision to keep the rate on hold earlier this week. After having moved twice in quick succession, it was appropriate to wait and assess developments both internationally and domestically, he said. He warned the ongoing trade war posed a significant risk to global and Australian economies. We have a lot riding on these disputes being resolved soon, Dr. Lowe said. Right around the world there's elevated desire to save and suppressed desire to invest. We're really responding to this deep structural shift in the balance between savings and investments around the world, and there's not much we can do about that. We can't escape the fact that globally interest rates are low. Dr. Lowe's appearance before the committee today comes amid accusations he has thrown up his hands and given up on stimulating the economy. Okay. I'm reading too much Austrian school. Just the idea of, artificially stimulating the economy. It needs to be allowed to adjust. Because what happens is, okay, you stimulate it. You artificially decrease the cost of money to encourage more people to enter the market, to encourage more people to take on burden. And let's just pump in negative interest rates to make it even more. Keep going. Boom, boom, boom. What's going to happen in the long run? Can you keep going forever? Can you? Liberal MP Tim Wilson, who chairs the committee yesterday, said it seemed as though Dr. Lowe had said he's exhausted the options of monetary policy. Well, monetary policy is very few options. Dr. Lowe pushed back on that this morning, indicated the RBA could lower the cash rate to zero, and it was examining other policy options used by central banks overseas, including quantitative easing. At least he didn't mention negative interest rates. I was worried we're going to head down that path. He said it was unlikely the RBA would actually pursue quantitative easing, but it was a prudent idea to consider. Okay. Now, for those of you that don't know, that involves essentially creating more money in the market, and it will mean that your purchasing power will drastically decrease as they do it. Mr. Wilson followed through on his promise to grill Dr. Lowe on the wisdom of keeping interest rates at historic lows, citing concerns the policy could become less effective the longer those lows persisted. I wouldn't accept the proposition that lowering interest rates is no longer effective at stimulating the economy. It's just different than it used to be, Dr. Lowe said. Just different than it used to be. Well, we've got access to more information, we've got access to more data, we've got access to more perspectives than we ever had in the past. I read the article from Bloomberg where they're saying the housing market is heating up, it's on fire, by quoting real estate agents, one example, and a tiny increase from one quarter to the next. So, I mean, maybe people are becoming more cynical. In today's environment, people don't run off to the bank when interest rates fall. They're more likely to pay down their mortgage. Yes, exactly. There really are a lot of questions that need to be answered before their decisions and what they're factoring in, Mr. Wilson told the AFR yesterday. The consistency at times between what their own internal research is showing around the consequences of lowering interest rates and the decision to cut interest rates is going to be pretty heavily focused. They're saying publicly at the moment that cutting rates won't increase the amount of debt and household prices, but their own research shows cutting interest rates is the biggest contributor to the volume of household debt and house prices. The internal research to which Mr. Wilson referred is a paper called A Model of the Australian Housing Market, which was written by the RBA analyst Trent Saunders and Peter Tulip and published in March. The paper found changes in interest rates were the most significant influence on house prices. The global trend of cutting rates continued on Wednesday. The Reserve Bank of New Zealand slashed its own official cash rate by 50 points, citing weakened global activity as a result of the trade war between the United States and China. Yes, well, you know, an economy with the biggest export is condensed milk. It still can't believe it. Shortly afterwards, the Australian dollar plummeted to its lowest level since 2009, when the global financial crisis ramped up. Earlier this week, former Prime Minister John Howard warned the RBA may have already cut rates too far, leaving Australia lacking ammunition in the event of another global shock. Don't worry, Johnny, they'll go negative. They'll print money or go negative. Speaking to the ABC, Mr. Howard said he was not sure that these interest rate cuts have been the right thing to do. I don't think that my advice will be taken. A number of reasons why we came through the GFC so well is that our interest rates were higher when we entered the GFC and the central bank had room to move. Yeah, it did. It really did. You could cut it 5% to stimulate the economy. Now, if you cut them too far, you get rid of that petrol in the tank. If something unexpected comes along, you don't have the same room to maneuver. It's a point of view, and I'm not claiming any special expertise, but I think we've gone quite far enough and perhaps too far. So what do you think with all Johnny's call, guys? Do you reckon he's right? Do you think he's right? Do you think Dr. Philip Lowe's push for government stimulus spending is the solution? Or are you as cynical about the ability of monetary policy to fix all our problems as I am? Let me know in the comments, guys. Like, share, and subscribe. And I'll see you all later. Bye for now.